Hey, it's Richard with Matthews Wealth Management. We're here for another market update. This is for the month of May. We're just going to jump right in this and keep it really short. So if we notice the differences here, we're basically still in line with the value rotation, especially when we talk about U.S. equities. We can see growth is falling off in large, mid, and small cap. Actually, it's jumping over into small cap core, but that's still part of the rotation. And you can see that the values are taking off. Year to date, that's been the case as well. We're still up in pretty much everything except for small cap growth year to date, but the big winners are going to be small cap value at 31%, 25 or 26% on mid caps, and then large caps at 15.68. So that was part of the big change that we made back in February. And I think as people start paying more and more attention to fundamentals of these equity positions, it'll make even more sense that growth is overvalued. And you're starting to see a lot of moves already in June on that. Jumping into international, everything's pretty much positive. A lot of that has to do with currency play when the US dollar is continuing to print and Europe has decided not to. We're starting to see a currency difference there, and that's what we're seeing. Some of our holdings at Matthews Wealth Management are hedged in foreign exchange currencies, so that's a little bit of a hedge within a hedge that we have in ours. So ours don't exactly track that, but yeah, it's interesting to see at least. Bonds have gotten incredibly boring. They're not moving very much, and a lot of that is just the low interest rates, low demand as well. A lot of these banks that buy government bonds to then sell to the Fed are in a position where they are capped out on liquidity. They have no more money to buy these bonds with. So we're going to see some very interesting shakeups when we see how the government can continue its big bond spending, and we'll get to that on key topics. But everything's tracking the way it should. High yield might be a little bit low on 0.3, but everything else is adding up, and our big play on tips is paying off. We're doing really well on inflation protected securities. Real estate just won't go away. We're still not foreclosing or evicting yet, so that's why it's made a huge run. It's up 16% on the year. We've scaled back pretty heavily in real estate. It's a timing thing. Who knows when we're going to start actually doing that. Oil has actually softened. We had the pipeline shut down and the hack, or whatever we want to say, and that was a gasoline shortage. It was not an oil shortage. So it's continuing to move up. I believe it's mostly inflationary. Gold is tracking inflation. We're actually seeing returns now on gold where it had been pretty stagnant. We saw silver last year take off, but here we are on gold pretty much flat on the year to date, but it's catching up 10% since we did our rebalance. So that's doing well. It was interesting this last month, S&P 500 was up 0.7%, and a moderate portfolio was right at 1. So here you see a lower risk and a higher return, and that's interesting. A lot of that has to come from the growth, less exposure to the downside in a moderate portfolio. So that's why we do those. That's why we start to diversify our risk. So let's jump over and talk about the key topics that I'm paying attention to and that clients should also want to pay attention to. What's on the horizon for capital gains and corporate income tax? A lot of people are saying, when does the market correct? When does it crash? Whatever terminology you want to use. This would be a big problem on a restart to an economy if you're going to start taking more from the reserves or the gains and profit and revenues that companies were expecting and missed out on during the year of COVID. So if we're going to increase capital gains, look for a big sell-off. I don't think it's going to be retroactive. They've been talking about making it retroactive to prevent a sell-off. There's very little support on the Democratic side for actually doing that. So most likely it'll be, if they do raise these taxes, it'll go into next year. So by the end of this year, you'll see a big sell-off to lock in 15% capital gains tax as opposed to higher. Same thing with corporate income tax. That's not going to bode well for jobs. Companies tend to look for the place where it's the lowest income tax. And right now, Ireland balked at the idea that Janet Yellen would allow the global tax to take place. They said, no, we're 12% and we're keeping it that way because it's competitive. And yeah, we'll lose some business overseas if we actually implement this. It's not going to raise revenues. So that brings us to deficit spending. That's the big problem right here. As I track inflation month to month and year to year and just keep talking inflation, the real issue is coming from the deficit spending, which comes, they fill that by printing bonds, which the banks buy and sell back to the Fed, who prints the money out of thin air. And this is really what's causing our cost of living to go up. I think everybody's very familiar with lumber, copper's catching up, the shortage of gasoline or whatever. We're gonna have high inflation because of our deficit spending. And until we get that under control, the family plan and all these other expenditure projects, I think 6 trillion on the horizon, it's gotta come from somewhere. I mean, there's one tax or another. We can call it the monetary repression tax. That is effectively devaluing savings and devaluing currency. So as we're continuing to print and spend what we don't earn, our dollars are worth less and less and less. And as world reserve status, that gets very hairy. So there's a lot of high up governmental decisions and policies that have to be worked on and thought through, and we may not be thinking it through. So here we go to the final part, hiring, which leads to supply chain. There's a shortage of everything from tires to chips to whatever you want to name out there. There's no supply chain. We shut down the economy, and since we paid people to stay home and $26 an hour, it takes a lot to get them back in the doors to actually start producing things and being productive for our economy. So in the short run, you're saying it's a transitory effect of inflation due to the lack of supply chain, which obviously is due to hiring, which goes back into governmental policy. So yeah, there are a lot of problems that seem pretty straightforward, but we've got people in charge that we just have to figure out what they may or may not do and plan accordingly and be set up before whatever happens. So tracking the inflation, we now hit 20 trillion. Congratulations, America. We have $20 trillion floating around in our economy. That's not good for inflation. That makes those previous dollars worth a lot less. Specifically, since January of last year, they're 30% less. So your 2019 dollars are now worth 70 cents. Great. We're gonna feel that, obviously, in expense inflation. CPI is what the Fed tracks, and who knows exactly what they're buying in urban grocery stores and so forth to come up with these numbers, but this is the definition of inflation if you look at just money supply. From a year ago, that would be as of May of last year, we're up 18% in this total dollars circulating. Year to date, we're up 3.68, and the last month was another percent. So we're just gonna keep on printing, keep on building this money supply, and it's gonna cause all of its ripple effects that we should have learned over hundreds of years of economics. So we'll learn it again the hard way. History will teach us. But hopefully that was a short enough meeting. If you got questions, feel free to send an email, phone call. We're not doing client meetings until mid-July. So yeah, we'll see you next time.